Pleasant morning to everyone and welcome to the PSE Stock Market Briefing. I'm John Garcia from the PSE's Market Education Department. We are joined by our guests from the listed companies, trading participants, and institutional investors watching us live via Zoom, and to everyone watching us in our Facebook live stream. Again, good morning. So earlier this year, we conducted a webinar and discussed how the market performed in 2021. One of the most extraordinary years in the history of the exchange and even in the financial markets across the globe. COVID-19 was and still continues to be the biggest disruptor in our lifetime. Market volatility was expected to persist in 2021, but this time with guarded optimism about an economic recovery as countries become more equipped on how to deal with the virus and are rolling out their vaccination programs. Do we still have the same expectations in the middle of 2021? That is exactly what we will discuss this morning. So today's briefing, we will have three presentations: a macroeconomic outlook, stock market updates, and a market outlook towards the remaining half of 2021. And please note that this briefing is for educational and informational purposes only. This should not be construed as a professional, financial, or investment advice or recommendation from the PSE or from any of our invited participants or speakers and the institutions they represent. Okay, so we have invited three speakers for our briefing today. The first presentation is titled Macroeconomic Outlook and will be presented by our invited speaker from Maybank Kim Eng in Singapore, Dr. Chua Hak Bin. So Dr. Chua Hak Bin is the regional co-head of macro research at Maybank Kim Eng, covering ASEAN economics and thematics. He was formerly a consultant at GIC and head of emerging Asia and ASEAN economics at Bank of America Merrill Lynch. Dr. Chua has also worked as a strategist and economist at Citigroup, Deutsche Private Wealth Management, DBS Bank, and RHB Bank. So prior to joining the private sector, Dr. Chua was with the Monetary Authority of Singapore for about 6 years, heading the external economies, financial surveillance and planning, policy, and communications divisions. Dr. Chua holds a PhD in economics from Harvard University and a Bachelor of Science in Electrical Engineering and a Bachelor of Arts in Economics from Brown University. He spent one semester at the University of the Philippines as an exchange student in 1988. Dr. Chua was a visiting lecturer in international economics at Yale University for a year after completing his PhD. We are so lucky to have Dr. Hak Bin with us this morning. Ladies and gentlemen, please help me welcome Dr. Hak Bin. Good morning, Dr. Hak Bin.
Good morning, John, and thank you for the opportunity and to the Philippine Stock Exchange for us to present our views here.
Okay, so we're very looking forward to seeing your presentation. Take it away. The floor is yours, Dr. A.
Okay, let me just pull out my slides. Okay, I guess we've titled it "Long and Winding Road to Recovery" because I think 9 months ago, even a year ago, nobody would have thought that this recovery would have taken so long and would have been full of starts and stops. So I think the main points I want to make is that this global recovery is happening and reopening. But Asia is lagging behind, right? There's a reopening in the US and Europe. They're going further ahead. But unfortunately, because lots of Asia is behind in the vaccine rollout, our reopening is later. So we hope that this could catch up by late this year. We are mindful that about US inflation. And unfortunately, inflation is also bifurcated. So we have a K-shaped recovery, but even inflation is K-shaped. And unfortunately, that could trigger an earlier US Fed monetary response, while the rest of the world is not in a firmer footing. So I think that could be a bit of a risk, and we'll see how that plays out. There's also the point about the taper tantrums when the Fed does eventually decide to taper QE. I think the markets are looking at January next year, and we all reflect back on the 2013 episode when there was a huge outflow from ASEAN including, and there was not just a stock market sell-off, there was also a currency sell-off. So, but we think that ASEAN is a better position right now. Larger foreign exchange reserves, stronger current account balances, but also not as exposed to foreign capital because ASEAN has not been the favorite place for the last 2 years. The money has actually gone more into China or India. Again, I think the recovery speed really hinges on the vaccine rollout and herd immunity. We're looking at Singapore fourth quarter, first half Malaysia and Thailand next year. But for the Philippines, I think we're looking at the second half of next year, given the current vaccine speed. Monetary policy will remain easy. There's extended fiscal support, but I think the fiscal support is starting to reach its limits. There are lots of risks out there. Clearly, we don't know whether there will be a Delta Plus variant that will be more infectious, or there's a Lambda variant in Latin America, or whether this Delta is it. U.S.-China relations hasn't improved. I think there were hopes that when Biden came in, that tensions would ease. Clearly, it's going the other direction. And of course, we don't really know post-pandemic whether there's a big debt overhang. The jobs recovery hasn't been that strong in many countries, and of course, border controls could stay a bit of a permanent fixture. And at the same time, there is a tech crackdown, a lot more in China now than the US, and also the imposition of minimum global corporate tax. So lots of risks to watch out for. We're looking for Philippines to grow, I guess, at a decent pace this year, but still not enough to recover above pre-pandemic levels. So when you look at the growth across ASEAN, it's really Singapore, Vietnam, and Indonesia that is really probably will surpass pre-pandemic levels, whereas Malaysia, Thailand, and Philippines will only recover to those levels next year. Inflation is picking up. I guess we're watching the risk of inflation overshoot, given rising energy and food prices and supply chain disruptions. Philippines is on a high side, but I think inflation has been tapering off, to just slightly above the target range right now. Again, this is just to show that inflation is picking up, but it's really bifurcated. It's higher in India and US, and unfortunately, because growth is driven by the US so much, and things really improve too quickly when the rest of the world is lagging, that also presents a bit of a risk to the rest of the world, because the US dollar still remains a big global reserve currency. And if the Fed tightens too early, I mean, it's good that the Fed is shifting its regime to an average inflation targeting, so it's willing to allow inflation to overshoot before it tightens. But the risk of a taper could still cause some volatility in some emerging markets. So COVID cases, I guess you're all aware of the numbers. It's unfortunate that ASEAN has become the hotspot, and that's affecting some of the mobility indices. So this is taken from Google. It tracks our mobility on a weekly basis. So it's a more timely indicator of how the COVID and lockdowns are affecting our daily lives. Whether we go to the malls, we go to the airports, and so on. And you can see here, Indonesia has really dropped quite a bit. Indonesia's situation is acute. The daily cases is above India. They are in a lockdown phase, and of course, hospitals are filled to the brim. Philippines seems to be slightly climbing on the way up, whereas at least going in the right direction. Still far away from the pre-pandemic levels, like 40% below. But compared to some of the other countries, Vietnam, Thailand, and Indonesia, which is seeing a dip, simply because the Delta variant is still growing and very difficult to contain. I guess this is just specific to the Philippines. Again, seems to be improving slightly on the margin. The trips to grocery and pharmacy is above pre-pandemic levels. But again, going back to the office, retail, still 20% below, but slowly climbing up. I think the key point is to watch the vaccination drive and how far that takes us, because I think presumably when we reach 50, 60, 70%, countries are willing to restrict the domestic lockdowns, but also hopefully some of the border controls, right? And you can see from here is with at least one dose, Singapore is ahead in Asia pretty much, and Singapore probably reached herd immunity earlier. Second is Cambodia for Asia, Malaysia 31%, but Philippines is only, by our track, is only about 10%, currently with a single dose. So it's lagging quite far behind. The chart on right shows the speed of the vaccination. So you can see the recent acceleration of late is actually on Malaysia's side, which is the gray line, but also the blue line, which is Thailand. And Thailand's, I think the progress has actually started to overtake Indonesia, which is starting to face some supply issues. The red line is the Philippines. It is progressing at I think the same kind of speed. So just to highlight that when you look back last year, a big reason for the sharp contraction in GDP growth was because of the loss of mobility, because of lockdowns. And here you can see Philippines was at the extreme end, because I think Philippines probably imposed one of the most draconian in terms of the extent of the restrictions. So severely hit the contraction of the GDP growth last year. And this uses the same kind of correlation as well, looking at the depth of the recession in the first half of last year, measured against the Oxford stringency index, depending on, and they grade it depending on how strict your lockdowns are. Again, Philippines was like the extreme end, and that also partially explained the depth of the recession. I just want to give you a quick look when you break down the recession last year, just to give a sense of what we're dealing with. And really, when you look back at the past recessions, for the most part, it tends to be a manufacturing or trade recession. So typically the story of a recession is, there's an external shock, the US slows down or something slows down in China, it affects trade. And so we hit the export side, and those trade sensitive economies tend to be hit hard. Well, this recession is very different, right? It's actually coming from the lockdowns and the COVID. So it's really more of a services recession. And in fact, some countries that kept the factories open, and manufacturing open, like Singapore and Vietnam, didn't really get hit so hard, right? And we saw how fast the trade recovery and the manufacturing side. So really, it's about services, and and then full-fledged recovery is really conditional on this services recovery. And when we can start going to the malls again and going back to the office, and going back to our daily lives. And just to highlight again, the manufacturing recession was very brief and fast. And you can see it here, just to give it extent of global manufacturing, the recovery was very sharp. Unfortunately, for some of the manufacturing PMI numbers in ASEAN is starting to roll over, right? And particularly the line that's plunged the most is actually the gray line, which is Malaysia, plunged about something like 37, in part because even the factories have to be closed now, right? Because of the spread. So that's a risk to supply chains, and even the glove factories, right? The medical component is also being affected. So I guess we have to watch for that, as well as even some of the China PMI numbers are starting to roll over a bit. So I think we have to see how this goes. I mean, I presume they will come back down, but it won't go below the 50, which signifies contraction, and settles at a rate still above 50, but so at a more moderate, sustainable pace. But given the tech crackdown more recently, we have to see whether it also dampens the domestic demand and growth recovery there. Again, just to highlight, when you aggregate ASEAN exports as a whole and you compare this recession in terms of the exports relative to the past recessions, you can see how quickly and how brief it was. So the duration is very short. It didn't really get hit as badly. And again, we bounced back pretty quickly. So I think that's still the story of this year, that when you look at global trade and all that side, whether you're looking at, shipping or air cargo or, ports activity, and if you're an electronics exporter, there are chip shortages. That part of the economy will continue to do well this year. The other thing, just to highlight that what's different, I think, is also the capital flows. That capital didn't really dry up, right? A lot of recessions is associated with a drying up, a sudden stop in capital flows. And I think for the most part, you can see what is in the tech investment, that continued to come in pretty much the whole of last year. And also that and of course, even the Philippines, when you look at the foreign reserves, which captures also what's happening in both the current account and capital account, you can see that this chart is the ASEAN reserves as a whole, that when you start from January last year, the reserves actually went up by over 120 billion, So that's a good sign, and that's support to the peso. And Philippines reserves, for example, increased about almost 20 billion, right, from January last year. So that's a plus, I think. Just to highlight the 2030 taper tantrum episode, just to provide a benchmark, of how bad the sell-off then. And you can see that, for example, the Philippines in 2013, when the Fed started tapering QE, the markets fell 22%, the peso get hit by 80%. So you got a 30% loss on your portfolio, which is almost as dramatic as what you see in a recession, right? I suppose a mild recession. But still, so far this year, markets down 4%, currency down 4%. And so in the scheme of things, it's not so bad. I guess when you look also at the performance across the ASEAN, it's a very divergent story, very uneven. And clearly, the economies that are that are recovering a lot more quickly. In Vietnam in particular, or Singapore has done a lot better. India has a strong IT services side, which is not really affected, and it's actually thriving because of the acceleration digitalization. Indonesia not as badly because their lockdowns weren't so severe last year, but of course now they're starting to tighten. So I think it really reflects more the extent of the lockdowns, the COVID situation in across ASEAN. Just to highlight why I think this time any kind of Fed tapering will not be as bad. When you look at the foreign equity inflows last year in 2020, which is the red line on the left, money was leaving ASEAN, right? They didn't really come to town. Whereas when you compare 2012, which the episode before the tapered entrance, ASEAN was in a bull market, right? The bonds and equities were all doing pretty well. That's the yellow line on the left-hand side. So we've got two very different episodes. So to the extent that foreign positioning is not that heavy, there's actually not that much money to pull out. Right? The ownerships is actually pretty low. Same thing in terms of the chart on the right. The money has really gone more to, you can see here, China in particularly. And I think, we've seen the vulnerability to the sell-off on foreign side because everybody was so overweight the China tech space. Some money also going to the India space last year. This just gives you the details if you want, which is breaks down the flows into the bonds and equity space. But for the Philippines last year, you can see that we've got 4 years of negative rate lines pulled out from the equity stock markets. So they've really left town. There's been positive money going to the Philippine bond market, however, which is the black, on the bottom side. So probably attracted by the more relatively attractive yields in the Philippines and possibly a fairly stable peso. Just a chart to show the foreign ownership of the equity as well as the foreign ownership of the bonds. Again, just to highlight that, I guess one positive supporting part from the Philippines is the current account position, right, which was in a deficit going into the pandemic that has flipped into a small surplus. So, possibly on a rolling sum, 4 quarters, about 3% of GDP. That's positive. I think that is also helped by remittances. I think at the start of last year, there was a lot of worry with the number of, foreign workers retrenched, and many Filipino workers working abroad also return, home, that there will be a sharp drop in the remittances. But actually, I think most are pretty impressed by the Philippines that the remittances last year only dropped by less than 1%, which is the rate row on the right-hand side chart. And that's pretty remarkable. And it's actually the best performing in terms of remittances when you compare to the other countries, because Indonesia remittances fell by more than 17%. Myanmar fell by 8%. Malaysia remittances fell by 15%. And of course, remittances seems to be recovering quite nicely in the Philippines this year. So that's really helped. That's a services export that enters in the current account that also supports the foreign exchange side and the currency. Markets are factoring tapering. I think pretty much the consensus is first quarter next year, but you can't dismiss late this year at the start of tapering. I think the Fed dot plots is looking at the first full-fledged rate hike in 2023. So fortunately, that's still quite some time away. But I think following last night's briefing, I think the probability of a first rate hike has gone up to about 40% for late next year. So something to still pay attention to. I just want to highlight that inflation is a key, play, and that will be a very key indicator. I just want to flash back to 2013 that even though ASEAN suffered, when you look at the US stock markets in 2013, and despite the Fed tapering from 2013 onwards, for the next 2 years, the US Dow Jones and the NASDAQ continued rallying. They only started stalling when the first rate hike occurred in 2015. So will it be the same story this year? I mean, we'll see. But I think part of the reason is because inflation was actually very well behaved, and therefore you can see that the yellow line was core inflation, the PCE indicator that the Fed looks closely at. The 10-year bond yield spiked up, just like we had at the start of the year, and then started tapering off. And then pretty much for the next 2 years, inflation was below 1.5%, right, in the US. So that really, I guess, gave the markets the room to run. But the question is, we've got headline inflation now above 5% in the US, 4%, for core. Is it really transitory, or is it really going to come off? So I think the inflation scare and debate is still very much in the picture. One of the post-pandemic, scars will be the public debt. Public debt has increased tremendously, not just in ASEAN, but across the world. And I think it's this burden that may potentially, cap the growth, post-pandemic, but also perhaps limit the room to which the central banks can raise interest rates. So for the Philippine case, public debt has gone up from 40 to over 55% of GDP. So far, core inflation is pretty well behaved here. But I think we're all watching the same things. Food prices have shot up through the roof, actually. So it's down 35% year on year. On a level terms, it's probably at I think a historical high. We've seen coal prices going up. Brent all go up, but not as bad as that much. And also things like coal prices. But also, I think you can see the supply chain disruptions. The cost of shipping something from China to LA is still like 500% above what it was pre-pandemic, and that's still high. And I would have thought by now, 9-8 months into the picture, that this rates will be coming off, but it's not, right? So shipping costs has gone up quite a bit. And of course, the other one is we've hear all about chip disruptions, hurting autos and sales and possibly handphone shortages and so on. So that's something an issue. And bear in mind, chip prices tend to go down, right? This is Moore's law, right? It's for the same technology. You will tend to get the chip, cheaper over time. In fact, chip prices have been raising up. So this is one side of that. I'll also be watching out for loan growth. It gives you an indicator where things are turning around. The loan growth has started to turn up slightly in Singapore, because there was a bit of a recovery, and then Indonesia. But for the Philippines, it's a bit worrying to me because Philippines used to have one of the highest loan growth, right, in the teens, and now it's gone into contraction, right? It's the line of the cross. So despite the reserve requirement cuts by BSP, it hasn't really shown up in lending and so far. We'll be watching out for the change to the global tax rules. Countries have basically agreed to impose a minimum global tax, 15%, and basically taxing also where customers are rather than where your regional headquarters are. So that may affect Singapore, for example, when MNCs are located here, they may have to, pay the taxes where, if it's the Philippines or Indonesia, where the customers, where they do business, rather than book it where their headquarters are. Just to highlight, we have a Philippines data point here that this is data from the US, the tax services, just to highlight that Philippines captures a very small share, of what US MNCs pay in terms of income tax, about just 0.3%. But Singapore is remarkably high at 7.5%, right? So for a small country. So there is going to be a lot of shift in bookings of where our tax services are made. For the Philippines here, we actually counted from the US data what the effective tax rate of US MNCs pay in the Philippines. Well, they pay about 23.5%. That's above the minimum rate, but it's not too far from the statutory rate. So it doesn't look as if the incentives are that great in the Philippines to I guess, worry too much about the impact. So lastly, I'll just leave you with this slide. I think whether you believe that we are going to be more of a great overhang, a more pessimistic case where higher government debt, will be an overhang, will prompt big tax increases, whether with an environment where supply chain is breaking up between US and China in particular, we're heading towards deglobalization, more protectionism, more strict border controls, and a drive for self-sufficiency. That's not going to be good for costs and production. So it's shifting things to where things are more resilient rather than shifting production to where it's most efficient. Whether we're in due for high inflation as governments basically monetize deficits, whether it's the QE from the Fed, Japan, ECB, Australia, or even for the Philippines, for example, where the central banks is starting to fund a lot of fiscal deficits, and also this intensifying US-China rivalry, right? So that's a more pessimistic, low growth, kind of outlook, or whether you believe in the roaring 20s, where suddenly we have this pent-up demand. Personal savings rates has gone up so much from consumers that after these lockdowns are eased, consumers are just going to spend like crazy. And whether we are in an environment where low rates and prolonged QE can sustain this consumer boom. And the pandemic itself has really sped up digitalization and perhaps broadened an area of technological renaissance, right? Giving a lot more opportunities for new high-tech companies. And of course, there's this strive now to improve infrastructure, not least because of climate change, but also to catch up with China. So there is this competition arriving on the infrastructure side, and whether that also lead to some kind of a boom and support, just like in the post-war period. With that, I'll leave you. And I'll happy to take any questions at the end. Thank you.
Thank you very much, Dr. Hakbin, for that very, very informative presentation. I mean, I really enjoyed listening to the presentation. My notes are full. I mean, I have some key takeaways. I mean, very, very good to note that while we experience this crisis, it feels like an Armageddon type, doomsday type. But really, looking at data, it's good to note that recession this time is actually shorter compared to the ones in the past, and that our recovery relative to our past experience is faster. I like the fact that you mentioned capital didn't really dry up despite the net foreign equity outflows in the ASEAN. Philippines being resilient, it's good to know that our remittance remains strong. And also on our road to recovery, everyone has to really watch out for inflation, because prices will really, across all sectors, will really rise as we take this road to recovery. And on a final note, BPOs really remain, or our business process outsourcing really remain, a strong contributor in our economy. So thank you very much for that presentation, Dr. Hakbin. Please stick around. We will have a panel discussion later, and we'll definitely, our participants have a lot of questions for you. Thank you again.
Thanks, John. Thank you.
Okay, so we will get back to Dr. Hakbin after the two other presentations this morning. So again, thank you for the time and expertise, Dr. Hakbin. So now that we know how the economy in the ASEAN looks like and where we think it will go for the rest of the year, next we will discuss how the market performed so far. So our next presentation, entitled The 2021 Stock Market Updates, will come from someone from the PSE. Our next presenter needs no introduction. He is no less than our President and Chief Executive Officer, Mr. Ramon S. Monzon. Good morning, Sir Mon.
Hi, good morning, John.
Glad to have you with us, sir, and we're very looking forward to your presentation. Floor is yours.
Thank you. Okay, I'll give a brief highlight of what happened in the market for the first 6 months. Okay. You'll see as of last closing date in July 28, the market closed at 6,473, 9.3% down from the close of December 2020. I'd like to point out here that we are on the way to recovery. We hit 7,036.38 last July 5, but with this increasing incidents due to the Delta variant, the market has slowly gone down. And as you can see, we're back down to 6,473. Next slide, please. Market liquidity remains very robust. As you can see, for the first half of 2021, our average daily value turnover is at 8.96 billion compared to 7.35 for the whole year of 2020. In dollar terms, we're averaging $178 billion $1 million a day versus only $146.1 million in 2020. You will also note that the share of the institutional investors have steadily gone down from 2019. Institutional investors went down from 82% in 2019 to 73% in 2020, and further down to 63% in the first half of 2021. This, of course, was taken up by the retail investors whose participation increased from 18.2% in 2019 to 26.9% in 2020 and 37.3% for the first half of 2021. We can see that, as Dr. Hakbin has pointed out, a lot of the foreign investors have left the ASEAN market, and the Philippines was not spared. You can see that foreign investors now just comprise 32.6% of our market, compared to 45.4% for the whole year of 2020, and as high as 55.4 for 2019. Fortunately, the slack or the departure of the foreign investors has been made up by the increased participation of the local investors, who are now comprising 67.4% of our market. Again, something to note of interest: foreign selling in the Philippine market has reached 77.86 billion pesos for the first half of 2021, compared to 128.57 for the whole year of 2020. So far, capital raising activities at exchange have remained very robust. We can see for the first half of 2021, capital raise at the Philippine Stock Exchange has reached 122.46 billion, exceeding already the whole year capital raising achieved in 2020 of 103.76 billion. So there's an 18% increase on the year to date between 2021 and 2020. For the remainder of the year, our listing pipeline remains quite robust as the economy recovers and business conditions improve. So far, we have applications have been filed with the PSE for capital raising activities amounting to 141.8 billion pesos, or $2.8 billion. These are for company. We have 3 REITs, or 3 retail estate investment trusts, that have applied for listing. Del Monte Philippines listing, a Jolly Foods preferred share listing, and Santa Lucia land follow-on offering, totaling 141.8 billion. While we have seen or have read in the news about 2 additional REITs that are planning to list, we have not yet received their application. This is really from Vista Land and the Double Dragon Jollibee Industrial REIT. For the upcoming listings, we have EI Corporation that has indicated and disclosed their plan to have a follow-on offering in the amount of 6 billion pesos. And of course, the big question mark is the power transmission monopoly, which is the NGCP. The NGCP has been mandated by the energy regulator to do an IPO, but to date, we have not received their application. The IPO is expected to raise about at least $1 billion. Now, I'd like to take this opportunity to inform the audience what the Philippine Stock Exchange is doing in terms of their capital market development initiatives. Basically, we have 3 strategic initiatives for the PSE. One is to enhance liquidity. Second is to leverage on technology. And third, become an ESG champion. For the strategic direction of enhancing liquidity, our initiatives basically are expanding the number of listed companies. We've taken the steps of liberalizing the listing requirements for both the main board and the SME boards. We've substantially eased the listing standards for SMEs, hoping to attract more SMEs to our market. We have introduced the sponsor model for SME board listings, and we have provided COVID-19 considerations for listing applicants. We have also relaxed our rules, and we have applied with our regulator to approve the listing of preferred shares only. In other words, company may list at the exchange only their preferred shares, even if they are not yet ready to list their common shares. Finally, we've also proposed amendments to the lockup rules for alternative investment funds like the private equity funds and sovereign funds. Next slide, please. Okay. Furthermore, to enhance liquidity, we feel this can only be done by introducing new products and services. The most important of which is we're trying to still follow up the approval for regulator for our short selling product, which I believe will be key to attracting foreign investors back to our market. There are just 2 or 3 items that our regulators have to, I guess, deliberate on before they give their approval. Nevertheless, we are launching or targeting the launch of short selling for the second half of this year. We will also be increasing our sector classification to comply more with the global benchmarks. We shall also be developing 2 additional indices for the year. One is a mid-cap index, and the other one's a high dividend index. Like I've mentioned before, we plan to also develop an ESG index for the first half of 2022. Again, part of enhancing liquidity is to strengthen the retail investor base. And what we want to do to strengthen the retail investor base is enhance. We've completely redesigned the PSE website to enhance user experience. The new website now has convenient access to listing-related materials for potential listing applicants. We have consolidated information on market data products. We have a new and improved charting tool. And finally, a centralized area for regulatory information. Of course, very important to strengthening retail investor base is, of course, our market education. We have, as you probably know, we have stock market webinars. We used to have quarterly webinars in 2019. We have now increased this to 15 webinars for each year, from 4 in 2019, which reaches more than 1 million Facebook accounts. We also have a online securities course where we partnered with the big university, De La Salle College of St. Benilde, for the online securities course, Certified Security Specialist course. We are also in the process of revamping our PSE Academy website. On the second strategic initiative of PSE for the market, we will be leveraging on technology to make stock market trading an end-to-end digital journey. For the second half of 2021, we plan to launch our data analytics platform, which will empower investors to analyze data on their own. It will democratize access to market data. Then, for our PSE EC Phase 2, for those of you who might not be familiar with PSE EC, it is our electronic allocation system, whereby local small investors have the ability now to subscribe to IPOs digitally instead of having to go in person and applying for some shares. This was launched in 2019 and has been very successful for the IPOs that we have launched. We are now targeting to have a Phase 2, which would integrate an online payment for the IPO subscriptions, and we would like to expand this platform to other forms of public offerings, like the stock rights offering, follow-on offering, and hopefully even retail treasury bonds. We plan to complete the Phase 2 by the second half of this year. We also embarked on a new clearing and settlement system, which is expected to go live in the first quarter of 2022. This new clearing and settlement system will enable PSE to have a T+2 settlement cycle, and will be able to clear and settle in multiple currencies other than the Philippine peso. Finally, on the technology front, we plan to launch an eKYC platform targeted for 2022. This will facilitate online KYCs for new stock market clients and hopefully will standardize info sharing between investors, trading participants, and regulators. Finally, on our strategic initiative to become an ESG champion, PSE is the first ever stock exchange to make a commitment to the United Nations Framework Convention on Climate Change. We made the first commitment in managing environmental impact. Our new offices have also changed their power provider from a coal-powered power provider. We are now using renewable energy company to provide power to our offices. On the S side, you can see that we participate in the annual Ring the Bell for Gender Equality. We have our various CSR activities, especially during the pandemic, where we've made several donations to the poor people of Taguig, Quezon City, Parañaque, and Calamba, as well as to the victims of the Al volcano eruption. And of course, for PSE, employee health, safety, and wellness are paramount. And we are proud to report that all PSE employees have been vaccinated with their anti-COVID vaccine. Finally, on the governance side, we're happy to report that PSE was a Golden Arrow awardee for best practices in corporate governance. We also have an annual partnership with the Securities and Exchange Commission in forwarding sustainability and corporate governance best practices. And we have had a series of roundtable discussions with publicly listed companies about sustainability issues. So that concludes my update for the first half of the market for 2021. And hopefully I was able to share with you the initiatives of the Philippine Stock Exchange for the coming year. Thank you very much.
Thank you, Sir Mon, for that very informative presentation. I mean, looking at the initiatives of the PSE and what we've achieved despite the COVID-19 pandemic makes me really proud to be part of this organization, sir. So it's interesting to note that retail investor participation increased significantly during the period, and capital raising remains robust at the PSE. Exciting year ahead for us as we have listings also in the pipeline, and more importantly, our initiatives, digitalization to leverage on technology to make our exchange more accessible for SMEs, and most importantly, the PSE to become an ESG champion. Thank you, Sir Mon, and please stay with us. We have one more presentation before we proceed to the panel discussion.
Okay, John, thank you.
Thank you, sir. So we have just learned from the two previous presentations about the state of the economy in the ASEAN, not only probably in the ASEAN, but also in the world, and how the stock market fared with these changes. So the next presentation, entitled 2021 Second Half Market Outlook, will discuss the outlook in the Philippine financial market. So this will be presented by Mr. Gilbert Y. Lopez. He's the Director and Head of Research in Macquarie Capital Securities here in the Philippines. So Mr. Lopez has nearly 30 years of experience in the Philippines equity research industry, making him one of the longest tenured analysts. He started out in December 1992 after earning his CPA title and graduating from De La Salle University with an accountancy degree. He has covered virtually all of the major industries from an equity research standpoint. So he has been with Macquarie Philippines since 2013 and currently does Philippines country strategy and directly covers banking, property, and conglomerate sectors primarily. Ladies and gentlemen, let's say good morning to Mr. Gilbert Lopez. Hi, Gilbert. Glad to have you with us.
Yes, good morning, John.
All right. So looking forward to your outlook for our market. So the floor is yours. We'll hear what you have to say.
Yes, thank you so much to all the callers. and all the participants. Let me share you my screen. Yeah, so just to begin with, for the balance of 2021, without a doubt, we are in the category of very optimistic because we have index target of 7,700 by the end of this year, which is supported on a bottom-up basis because it's based on the underlying price targets for the index constituents. And that despite the fact that on a macro basis, as a house, we actually think that it will disappoint consensus by forecasting only 4% GDP growth for this year. We do think, however, the main driver for the increased optimism is what we consider as a pleasantly surprising vaccinations rollout. The latest daily average has exceeded 300,000, and we do think that there will be raised hopes of pushing forward toward herd immunity goals. Of course, everybody's going to be interested in what we think about the 2022 elections, but I think it's too early to make any conclusion there or even bold predictions because the most important event prior to that hasn't come yet, and that's the candidacies declaration to have a complete picture of what the lineup of presidentiables will be. So get back to me or get back to us in October when the final lineup is declared. That said, we also think that one thing that supports the market on our bullishness is really interest rates. We think interest rates will be kept low. I think monetary policy will be a crucial fixture to getting this economy recovering, especially with the backdrop that our level of stimulus has been much lower compared to other countries. And with this in mind, our bias is towards actually cyclical sectors. The remainder of 2021, we think property sector would be the best sector to go for, followed by the holding companies, the conglomerates. And then next would be on a selective basis, we also like consumer, which in a way provides a little bit of a barbell strategy. We do think at our index target of 7.7 on a 2021 earnings view, which mind you, is still below the normal earnings level, already gives you a 22 times PE multiple. I do think that for the market itself, the index target of 7.7 is also premised on some reversal of the net foreign outflow that we've been seeing year to date. And that actually has been the case for the Philippines for several years already. I think roughly around 7 years, we've already been seeing more bias towards net foreign outflow. Of course, as what was mentioned in the presentations earlier, part of it is ASEAN becoming less in vogue. But I think also Philippines people have found it to be not as attractive in the last several years. And the hope is that there will be some return into that. I think the vaccination process is important, as well as a little bit more excitement or hope with regards to the upcoming elections to a lesser extent. Moving on our macro forecast, just giving an overlay before I head off to talk about what we think with the individual sectors. We do have a below consensus GDP view. I think it's being driven more than anything else by investments on the private side being sluggish. And we think that private sector investments will not be able to support because we think that it will be still remaining wobbly because of the pandemic uncertainties, as well as also to a lesser extent the political situation being relatively uncertain also, even though it's something that should be expected every 6 years. So we think that for those that are closely following economic growth in terms of decision making on the Philippines, you'd have to look at 2022 growth, where the situation is improving. But we do think that being overly focused on 2021 has its risks. I think earnings are recovering quite nicely already. And in fact, the start of the second quarter results season imply that we're already starting to see companies, if I'm not mistaken, over the past week, trickling in of earnings results. It's been more biased towards positive surprises than anything else. We do think that inflation is less of a concern these days, and that really helps the policy rate. And we think that as a house, the taper risk is there, but it's rapidly being pushed back towards rates rising in the US, in our view, towards an early 2023 story. We do think that remittances will continue to be supportive of the economy. And finally, when you look at loans growth, we expect it to stay in negative territory for this year before moving into positive mid-single digit by 2022. In addition, of course, BSP should at some point later this year do another triple R cut in line with its longer term objective of aligning the reserve rate requirements with the rest of the region, which are mostly in a regime of mid to low single digit level. So at the moment we're at 12. I think certainly there's an impetus for that to happen, notwithstanding loan growth still being quite weak. On a quick macro view, the most important chart really here is the daily cases. We're looking at daily cases being much less compared to the peak. Knock on wood, we hope that it doesn't begin testing the 10,000 level in April. And I do think that that would be underpinning, along with the faster vaccination, in terms of lifting ourselves out of this economic rut. I think in 2 weeks' time, we should have the second quarter GDP out. You'll see on the right upper hand side that quarterly GDP was heavily negative the last few quarters. But I think partly because of base effect, you finally see a good number in the second quarter, which to us, we're looking at between 9 to 10% GDP growth in the second quarter alone. Admittedly, it's on a base effect impact. And then we talked about CPI being less of a concern these days. And then finally, on unemployment, it's admittedly still on the high side at near 10%. But as with prior years, we've continually been saved by the remittances remaining positive, and that will continue to be a lifeline for the economy. On the vaccinations front, last week we reached the 300,000 milestone average daily vaccines. And we think in terms of reaching herd immunity, we're estimating that if somehow, and it's not completely out of the realm of the possibility, that they end up the remaining days of 2021 at above 500,000, a herd immunity goal by early first quarter 2022 could indeed be achieved. Do note, a couple of days ago, we did exceed 600,000 in vaccination. So given that we have actually a lot of parallelisms, but hopefully our mortality doesn't go there, but we have some parallelisms with economies which have similar per capita GDP and similar democratic governments reliant on local government push for vaccinations, like Indonesia and India. We should be able to ramp up vaccinations further, which has been a pleasant surprise, to reiterate, compared to the social amelioration package rollout last year. So it's good that the vaccination process has accelerated. And indeed, in terms of vaccine arrivals, we already have more than 30 million that's already in the country. That should help in terms of the vaccination process. And before I leave this topic, on a personal level, the concerns on the Delta variant are quite valid. But if the vaccination does really pick up, it goes a long way towards lowering mortality, because various DMs that have been successful in terms of vaccinations have seen their level of mortality really much lower, as measured by hospitals that have been still under capacity, meaning they've not really gone to the brink in terms of hospitalizations. And I think case in point will be nearby Singapore, where they've already reached 70% level of vaccinations, and there are plans for them to reopening their borders this September. It's going to be a good test case for us to eventually replicate that. So at least it's a nearby country. Of course, it's not quite an EM like ours, but it's something just next door, and it could be a goalpost for the Philippines economy and even for our government and of course the private sector on what to expect. Just moving on to our sectoral preferences. So as mentioned, we like property the best, and then followed by conglos, then consumer, and then rounding out would be utilities and banks, which we find less preferable these days. But we do think that the economy on our coverage universe is more than 160% growth for 2021, but partly because it's a low base, and then normalizing somewhat to 2022 at 37%. Just looking at TCOMP itself, we estimate that the EPS growth is more like 43% for 2021 and 24% for 2022. Note that the 164% is the Macquarie Philippines coverage universe, so not quite, and that includes a lot of, at the moment, non-TCOMP stocks. Moving on a per sector basis, so we like real estate the most. I think residential is the sub-segment to really focus on, and that's the reason we like it, because of interest rates being favorable. And I think what we're seeing is that the banks themselves have become more aggressive in terms of rolling out mortgages, which bodes well for the real estate sector's residential segments. And because that's against the backdrop of banks having a difficult time growing their corporate book, which would be typically 75 to 80% of their book. So they've discovered once again that mortgages are a safer thing to push, especially when you consider last downturns, these were the least adversely impacted in terms of defaults. So, the residential focused developers should give you the most upside for the balance of this year. For the holding companies, we like them mainly because of the earnings bounce, even though it's partly driven by base effect. But we find that they're actually doing better. As Mr. Monzon mentioned about ESG, our analysis is that they're a bit ahead in terms of the other sectors on ESG efforts. And we like most those that are having a clear strategy in terms of improving their ROE and being able to revert back to pre-pandemic. And we also see that a lot of the holding companies are this early stage are showing to be one of the first ones to exhibit recovery as a cyclical sector. So they seem to be a little bit ahead in terms of real estate. But the reason why we like real estate best, there are admittedly a lot of moving parts in terms of the holding companies. And then moving on to the next sector, we like on a selective basis the consumer sector. We like those that have very resilient domestic businesses, combined with also an overseas business that's giving you a better growth profile. Given especially that Philippines is admittedly a little bit behind our regional neighbors or even overseas in terms of economic recovery. Plus, of course, there's that added bonus of having improved margins. We do reckon, of course, that as a warning, unlike in past elections, we think that election-related spending will be less prominent, partly because of base effect and partly because of the pandemic limiting the opportunities to really spend like we've gotten accustomed to, especially in past presidential elections. In any case, we think that the uptrend is there for consumer sentiment to show an improvement. And then rounding out to sectors we don't like as much, but we still think that there's upside because it's very under-owned. Utilities, I think it will be favored by an improvement in terms of the regulatory landscape, especially starting 2022, that should be much better. And we're seeing also benefits from having relatively tight supply-demand situation, and some of these are beginning to see it in terms of better top line through higher selling prices, in addition to additional capacities coming through. And then finally, banks. It rounds out our sectors, but we do think the main reason why we are not wholeheartedly pushing banks is really because loan demand is on the weak side. We think that it will stay negative for the balance of this year. And I think at the start of the earnings season for this quarter, we're beginning to see that sort of indications that loan demand isn't there yet. But nonetheless, what is clear, and you'll see this in the monthly NPL information released by the BSP, is that asset quality deterioration is decelerating big time. And I think that could justify a big reduction in provisions, and that partly helps the growth for the banks as they wait for loan demand to make a positive turnaround. We do think that the sector also has to face the risk of added disintermediation, as well as disruptors coming from fintech. And I think in terms of the digitalization process, despite efforts on their part to be giving importance to this, we are still, as a sector, the banks itself are still behind the region when it comes to digitalization. So admittedly, this will limit widening jaws, i.e. Costs coming off slower or rising slower compared to revenues. So in a nutshell, really that would be my presentation, but just wanted to highlight as I move back to the things that that need to occur for foreign investors to return to the Philippines. Really, it would be great if there would be more investable companies. I think we're doing baby steps towards that. Over the past 12 to 18 months, we've seen several good IPOs, which are welcome in the Philippines market, that many of them have done well and are trading well above their IPO prices, and also have liquidity, because that's one of the big pushbacks as we talk to foreign investors. And I think down the road, and I think it would be somewhat connected to ESG efforts being ramped up, is that we want to see more of the companies pushing for bigger floats. I think it's always welcome if the floats are larger, ideally above 50% free float versus the norm, which is below 30% for most of the largest or top 10 PCOM constituents. And in addition, it would be quite good if the IPO flow may not necessarily have to be for 2021, but who knows, 2022 onwards, there would be more new economy stocks, more unicorns, hopefully within the Philippines. And we could follow the footsteps potentially of a country similar to ours, but already has a few interesting unicorns, like in Indonesia. So if we could have something like that down the road, it will be quite positive as well. With that, I could end here and hand it back to John. Thanks.
Thank you very much, Gilbert, for that very informative presentation, insightful as well. I like the fact that you guys are highly optimistic there at Macquarie, with an index target of 7,700 by year end. And despite the Delta variant, causing the increase in the COVID cases, it's good that you noted that the vaccination drive will indeed help lower the risk of severe COVID cases due to the Delta variant. I will get in touch with you again in October, Gilbert, to ask about the elections. Anyway, so we now proceed to the panel discussion. So let's bring back Mr. Monzon and Dr. Hakbin on stage or on the screen for our open forum. So we have covered a comprehensive view of the market from its performance to the outlook moving forward. Now let's go to the panel discussion. So here's how we'll do it. I'll just look at the questions typed in our Q&A, and I'll direct it to any of our panelists. So if you guys want to add, just feel free to add. So this is a free-flowing discussion. Let's try to be relaxed and more candid on this one. So you guys ready? Okay, so looking at the smiles, I guess they are. I have a question here for Dr. Hakbin. Are you concerned on the on the Philippines credit rating? So we recently adjusted the credit rating outlook to negative. So are you expecting any downgrade, if any?
Yeah, I think Fitch downgrade was based on a couple of factors. I think they see downside growth to potential growth and potential scarring effects, given the debt buildup, on post-pandemic. And of course, they will also consider about the challenges of unwinding the exceptional policy response. I mean, the fiscal deficit is about over 7% of GDP. And of course, the central bank has also been monetizing, I suppose, the deficit. I guess we calculated, we get a figure something like 80% of the fiscal deficit is essentially being monetized. So the BSP is doing QE de facto, and there will be some difficulty, I suppose, to return fiscal policy to kind of a more prudent stance in the future. So it's a downgrade on outlook, and I think ultimately also depends on the really the COVID situation, right? I mean, if this thing's going to be still with us 6 months, I don't pretend to know, because this is a lot more infectious and lockdowns are still in place, then sure, there is a risk of a credit downgrade. And of course, if by then vaccination is closer to 70-80% and we can open up, then I think then the downgrade may not be warranted.
Okay, thank you, Dr. Hakbin. How about you, Gilbert? What's your take on that aspect?
It was a long. What particular aspect on the Fitch?
Yes, on the downgrade.
Yeah, I think we are not, as a house, we're not as concerned. I think, remember that cross EMs, most countries have spent even more aggressively than the Philippines, putting it mildly. And if Fitch is looking at debt to GDP as a red flag, I can't really blame them. It's worse in other countries. I think the reality is, the bigger concern is that if the economy is permanently scarred, and as a house, we think that's not necessarily the case. And even at this point, despite all the foreign investor outflow or net foreign selling year to date, overwhelmingly, people still believe that the economy of the Philippines longer term is still sound. But obviously we can't be relaxed there. And hopefully the technocrats are aware of this. But I think the Fitch ratings downgrade is not an overly huge concern. And I think it's more of a wake-up call.
It's good. It's good to have those wake-up calls every now and then, to keep ourselves in check and to see if we are really performing performing to expectation or below or above expectation. So good points on that one, Dr. Hakbin and Gilbert. Sir Mon, based on your presentation, there are several big ticket listings this year. How about for SMEs? What are our initiatives or programs to encourage more SME listings here at the PSE? Sir Mon, I think you're on mute.
Well, as I mentioned in my presentation, the PSE really is the listing, standards for SMEs. From before, you had to be, existing operating for 3 years. We've reduced that to 2 years. Previously, you had only you need to have, I guess, positive EBITDAs for the 3 years that you are operating. Now, even if you are not profitable, as long as your sales figures show a 20% increase, then you'll qualify for listing. And finally, if you can't meet those two metrics, all you have to do is look for a sponsor, okay, who's obviously has been accredited by PSE, because the listing sponsor now will be the one to evaluate the applicant's suitability and will be the one to endorse the listing application of the applicant to PSE. The sponsor, of course, will be responsible for hand-holding the company from its IPO preparation phase to 3 years after listing to make sure that the company complies with the initial and continuing listing rules. So we've had, we've made sure that, we attract a lot of SMEs. We've partnered with many organizations. We've partnered with the Philippine Retailers Association, the Philippine Franchise Association, and we also have an ongoing dialogue with the Philippine Board of Investments. Hopefully, we can convince the BOI to require that all companies that avail of incentives from the government will be, offering the shares to the public. That's one of the things we're doing. And finally, we've launched what we call a hand-holding program for SMEs, where we, guide companies from, to prepare them for their IPO journey. And I'm glad to report at the moment, we are hand-holding 23 companies that are interested in going for an IPO.
Wow, sir. Very, very interesting to know that the PSE is proactive in reaching out to companies to tap the equity capital markets. And good to know that 23 companies are actually part of our hand-holding program. Sir, on the investor front, in your presentations, very interesting to note that we've seen an increase in the retail investor participation. So what do you think drives this increase in the retail investor participation in our market? And can we maintain this level?
Well, I think I venture to say there are 3 factors that I consider, instrumental in getting retail investors to invest more in the stock market. Well, first of all, I think the rise of digital technology, okay, which made it easier and more convenient for retail investors to delve into stock market investing. Of course, during the pandemic, during the lockdowns, as I've mentioned, we increased the frequency of our webinars. So our stock market education has been, more frequent. And I guess people who were not doing anything, were tuning into our webinars and were able to get themselves interested and learn about stock market investing. That's number one, the digital technology. Number two, of course, is at the time that, we had the pandemic, as you know, our stock market really went down substantially. So there were bargain prices for stocks. And I guess this attracted a lot of the retail investors. And I think a lot of the retail investors really made money, during the last half of last year. And finally, well, because, consumers were under lockdown, they could not travel, they could not eat out, they could not shop. So they had a lot of disposable income. And I guess this disposable income found itself in the, in the stock market. I mean, good for them,
Very interesting, sir. Really, the technology is the way to go. And looking at the presentation earlier, there are a lot of initiatives by the PSE to leverage on technology, especially to enhance retail investor participation. Now, more on the investor front, I have questions for both Dr. Hakbin and Gilbert. I think we'll start with Gilbert. What do you think will attract foreign investors in the Philippine stock market?
Yeah, thanks, John. I think interesting question, just to reiterate. I think longer term, I hope we see an emergence of unicorn stocks, like what we've seen in Indonesia and even North Asia, like in Korea. That's a long way, but in the near term, I think more than anything else, if we get the vaccinations much faster, and if Philippines somehow is able to make up the deficit that it's seeing versus other ASEAN countries in terms of vaccination rate and the total population already having 2 jabs, I think that will also be supportive, and as well as delivery on the ESG. Although that also is more like a medium to longer term thing, but it's good to see that the PSE is making it a centerpiece in terms of their emphasis. And then down the road, in addition to the unicorns, is that if there's more liquidity or big IPOs, and maybe a further relaxation on profitability requirements for even large companies, that would be quite good. Really, the important thing is for us to stand out in a region, admittedly, that's been relatively out of favor. And at some point, ASEAN will have its view. That's my view. Thanks.
Thank you, Gilbert. How about you, Dr. Hakbin? What's your take on that topic? How will foreign investors or what will drive foreign investors back to the Philippine market?
Well, I think Ramon and Gilbert has kind of highlighted the key points. And I think one is really a lot of ASEAN and the Philippines are really old economy stocks, and old economy is just, well, out of favor, right? And you can see that, I mean, Malaysia was recently a listing of a tech company, and that's where the excitement is, and that's where I think investors want to invest in for growth. So, hopefully with the change in listing rules, if there are more listing in the digital space or unicorns, I think that will bring back, foreign interest. Second point is, I think there's also a hunt for yield still, right? So I think the development of REIT market, as Ramon has highlighted, will be a big plus, right? And I think you can see that the Philippine bond market has actually done pretty well. It continues to attract foreign inflows, and there were more yield instruments, 4%, 5%, 6%, 7% yield. I think that will, attract considerable foreign investment as well. But thirdly, I would just, as Gilbert highlighted, it's really about the replay on economy when things reopen. So when can the economy reopen? We've already seen, when Singapore could open, all the bank stocks starts rallying, all your hospitality stocks start rallying, all the property, plays come back. And that would also happen to the Philippines as well. It's just a matter of timing. Do you get in now, when the vaccination rate is only 10%, you get in when it's 50%? I think as clearly vaccination approaches 60, 70%, I think you have to, invest back in some of this place that will benefit from reopening.
So while there are a lot of factors that we can consider, majorly it really depends on the reopening of the economy, the vaccination drive of the people, and another aspect that we can look at is probably the introduction of new products. It's really good that we have a lot of REITs in the pipeline. Yes, sir. Yes, sir. Yes, sir.
Yeah, I think Gilbert and Dr. Hakbin, are very correct in mentioning what they thought to, attract foreign investors back to our market. But one of the things that I think we should, well, actually, the PSE and the SEC were working on this initiative to increase the public float of listed companies. Okay, as you know, right now, the public float of companies that are listed is only at 10%. Of course, the IPOs now are required to offer 20%. But prior to the pandemic in 2019, the PSE and the regulators are talking about increasing the public floats of listed companies to 25%. Something that you don't do in 1 year's time, but over a period of 3 years perhaps. And I think that's very important because by increasing the public float, you really increase the, I guess, the alternative or the choices for foreign investors.
Good point on that one, sir. And also thank you for highlighting that we are increasing the public ownership requirement for our listed company. Actually, Sir Mon, there is one particular question here for you from Rexter. First, he wants to thank us for the insightful presentation, but what is your outlook, I mean, personally, for REIT investments in the Philippines for the next 10 years? Currently, US REITs and Singapore REITs comprise 59% and 3% of the global REIT market capitalization. So in your opinion, do you think we can position ourselves in REIT global market capitalization in the next 10 years?
Well, yes. Actually, what we are seeing now, we are attracting the big, property developers in the REIT market. But really, I mean, we were pushing for the for this REIT product, not only to, for the big, I guess, real estate developers, but we wanted to target the, the medium and even the small, property developers so that they could recycle their capital and, and invest. So having said that, I'm very, very confident that, we will see more REIT listings and hopefully not just from the big players.
Thank you very much for that one, Sir Mon. I think at this point, while there are so many questions, we want to answer all of them. We are pressed for time. Maybe we can just ask our speakers to give their key takeaways or parting words for our audience this morning. We'll start with you, Sir Mon.
Well, investing in the stock market is not a short-term thing. I mean, it's a long-term journey. But history has shown us that investments in equities will definitely return more than other investments. And I think it could also be a safer, I guess, form of investments than the other investments out there that are not regulated. So for the investors, just be patient. It's not a get-rich-quick scheme. You invest for the long term.
Very, very, very wise words. Invest for the long term. Thank you, Sir Mon. How about you, Dr. Hakbin?
I mean, I think, at least at this stage of the cycle, we can see light at the end of the tunnel compared to a year ago, right? So I think it's, let's not be too caught up in the doom and gloom, And it's just a matter of, putting in, and you're right. I mean, investing, we have to hedge ourselves against inflation. We have to, make sure that we have adequate retirement and so on. I think the key is still diversification and to just, manage the risk. Thanks.
Okay. Stay optimistic, light at the end of the tunnel, and remember to diversify. Thank you, Dr. Hakbin. And finally, Gilbert, your parting words for our participants.
Yeah, to our participants, I think just hang on tight. We're probably facing a tough month of August, but I think that's a great opportunity to build a base for the equities market. I would say that as to echo what Dr. Hakbin was mentioning, we'll have our place in the sun quite soon because as a market, we still tick most of the important boxes in terms of attractiveness, and we do have an additional catalyst coming middle of next year that I think net regardless should be taken as an additional positive. So that's it. Thanks.
Thank you very much on that one, Gilbert. So I guess that's all we can do today. You're gonna start investing, hang on, and hope for a more positive future. And that wraps up our stock market briefing today. We've had such an eye-opening time in the panel. Thank you to our panelists for your time, for your expertise, for your sharing your insights. And also, we'd like to extend our heartfelt thanks to our participants for actively participating. And with that, we bring today's briefing to a close. Thank you for spending your Thursday morning with us, and we hope you learned a lot in this session. So stay tuned to our social media accounts for future briefings and webinars. Okay, so just some closing. If you need to get in touch with the PSE, our contact details are at the screen right now. You may call us at 632-8876-4888 or email info@pse.com.ph. Please visit our website, www.pse.com.ph for disclosures. Visit PSE Edge. For investing materials, visit the PSE Academy website. And of course, we are active in social media. Do follow us. We are on Facebook, Twitter, Instagram, and LinkedIn. And to those who are asking if for copies of the slides, don't worry. A recorded version of this briefing will be posted in PSE's YouTube channel. So do visit our YouTube channel, and while you're at it, please subscribe. So also, some plugging of PSE mobile apps. Our apps free for download, PSE Edge for information right at your fingertips, and PSE Easy for whenever there's an IPO, that's the app for you. And again, I would like to thank everyone for attending PSE's 2021 mid-year stock market briefing. This is again your host, John Garcia, wishing you all a prosperous year through the rest of 2021. Thank you, stay safe and well.